Hey guys, and welcome to Finance Friday. It's a really good question and one that I get asked a lot, but to be honest you can't really answer it with one being better than the other. Both fixed rates and variable rates have different purposes. They present different benefits and obviously present different risks at the same time. Variable rates have been very stable for 2 to 3 years now, but those of us who've been borrowers for a while will know that this hasn't always been the case. Variable rates can move up or down, and when they do, they often do so in clumps. Variable rates usually fall when the Reserve Bank wants to stimulate the economy. Now, for those of us with variable rate home loans, we benefit when this happens by way of a reduction to our own home loan rate. In essence, our home loan becomes cheaper. On the flip side, when the Reserve Bank wants to slow the economy, we sometimes see rises in these same interest rates. Now, this is where a variable rate has an element of risk. Increases to our own home loan rates means we're effectively paying more interest on the money we've already borrowed. Worse still, in some situations, we may be required to increase our loan repayments if the current repayments won't clear the loan within the agreed term at the new higher rate. And this is where some borrowers enjoy the certainty of a fixed rate. Regardless of any movements to variable rates, if your loan has a fixed component, the repayments on fixed rate loans won't move until the fixed rate term expires. At that time, the fixed rate component will revert to the variable rate of the day. Now, most banks these days offer fixed rate terms for 1 to 5 years, and there's a general rule: the longer the term that you fix for, the higher the rate will be. This is because you're basically paying a premium for the certainty on your interest rate. The longer the period of certainty, the higher the premium you'll pay. Now, the main risks with fixed rates is the obvious one, being that variable rates fall after you've fixed your own home loan rate. Remember, even in these instances, you'll have a legal contract with the bank to keep paying the fixed rate that had been contracted for the remainder of the fixed term. You can break these fixed rates sometimes, but if you do so, you'll usually be faced with a cost, and these costs can be significant. The next question is how to decide which option is best for you. It's not for today, but next week I'll help you more on that on our next issue of Finance Friday. Until then, have a great week.